Okay, good afternoon, everybody. Scott Hamilton, CEO of Executive Next Practice Institute. Welcome to our next session on Is This the Year to Exit? First of all, I want to welcome everybody, and we'll be having people join us here both via Zoom and YouTube and other live stream channels. So thank you all for taking your time during lunch for this very important and timely session. Let me start this way and take a look at what we're going to cover today. And Jason, if you'll give us a thumbs up on the view here. Thank you. So again, my name is Scott Hamilton, President, CEO of Executive Next Practice Institute and Nextwork Strategy. Just want to kind of set the stage here for you today in terms of what we're going to be covering. And I know Jason will be onboarding people as you come in. But again, we're showing this for different channels today because of the importance and timeliness of this event. So let's get into it this way. First of all, many of you know who Executive Next Practice Institute is. We're based at the University of California, Irvine, Beal Applied Innovation. The picture you see there is what we used to look like in March, the old days, March of 2020, when we pulled together 100, 200, 500, 1,000 people into a room for these kind of collaborations. We will soon be back to that. We anticipate in the third, fourth quarter of this year. This is forum number 423, workshops, forums that we've done globally. And again, this audience is primarily Southern California today, but we've also had quite a few people join us from across the country and even from Europe. I see Mexico, Canada joining us today. So with that, we've got three stellar speakers today from US Bank Private Wealth. And we're just delighted to have this partnership with US Bank. Again, perfectly timed content based on some of the decisions and expected decisions you've heard come out of Washington and Sacramento just in the past 3 to 4 weeks. So we're going to have a chance to look at some of the financial, regulatory, tax impacts and the implications for your business. So want to kind of keep going with that. And let's see, just one moment as we do a couple of quick things here. And one moment as we get lined up here with a couple of more people. We've got quite a few people coming in from different directions. All right. So Jason, I've got you onboarding some of these folks coming in from different channels. All right. With that, again, looking at this partnership with US Private Bank. And again, we've had this discussion now since with Michael Lewis and his people since, I guess, January about what was going on in the capital gains arena, what was happening with corporate taxes. And just felt like this was a perfect timing to start to cover this. And as we see it unfold over the next coming months. I also want to thank all our partner organizations that jumped in to support this event. All the UCI Beal people, the Paul Mirage School, Miller Farm Media, our production manager here, Tech Coast Angels, Forbes, all of these folks have been, Greater Irvine Chamber, all these folks have been instrumental, not only this event, but multiple events, and will continue to do so this year. The premise behind today's session and Executive Next Practice in general, again, this is number 423 forums over the years, is it's important for you as a business owner, a C-suite executive, investor, community leader to get outside of your industry, get outside of your circle to look at new information. Because much of the innovation and much of the business value you're going to get as we get into the second half of 2021 into 2022, the most valuable information you're going to get is going to come from outside your industry, not from within your own industry. So if it's increasing the value of your business, if it's increasing the value of your value proposition to the customer, it's often the new ideas are going to come from outside your industry. That's why we mix you up. You're going to see today at least 14 different industry sectors are involved in today's viewing, and business owners from across the spectrum, all different types of sectors. So again, welcome and thank you for joining us. Our whole premise has been developing what we call next practice strategy. That is, what are the tools, techniques, policy practices, culture, capabilities we can develop with your business that will take you beyond the competition and allow you to thrive in this kind of changing environment. So next practices has never been more important than today in terms of looking beyond the status quo. Now, here's where we are today, May 20th, 2021. We've all been operating in this kind of virtual fog, this COVID fog now for over 12 months. And the difficulty has been that it's impacted our customers. It's impacted our culture because we're not face-to-face with our employees and our customers. Financially, hopefully we've got a tight ship there, but also you might have seen some issues there. I mean, we're certainly hearing it from our friends in the purchasing community, some real nightmares going on. Operationally, you may have lost some focus because of all this, this distance we have between us. And then finally, there's a real concern about the execution of what we're doing. Even if we have everything lined up, are we appropriately staged to execute, whether it be staged to execute an exit strategy or to build on what we have and moving into 2022. By the way, I just want to stop here for just a minute. If you're not muted, please mute now because we're going to have a lot of people on the call. We've deliberately set this up as a meeting so that you can participate live here in this discussion, but mute yourself for now, if you will. All right, moving forward. Given this slide, we are now working with a lot of clients, business owners, C-suite teams right now in live settings and in remote settings to get their strategy right for 2021 and 2022. So we actually have been pulling groups together here at UCI and other locations to work on their strategy via our NextWorks division. And they're uncovering a lot of issues that came up during the past 12 months they weren't aware of. They're finally getting together as a group and saying, you know what, we've got an issue here. So this is what we strongly recommend to any of you on this call today and beyond. Get your team back together some way, even if it's not face-to-face, get them in some type of orchestrated event, strategy working session, find out where you are, and make sure you have the plans going forward for 2021 and 2022. That's critical right now as we move into this next period of time into the third, fourth quarter. All right, here's our agenda. I'm about to end up my piece here. We'll get into the U.S. Bank presentation with these three stellar speakers. Our production partner, Miller Farm Media, is going to give you some tips around how to prepare your business, whether you're going to exit or not. And then we'll get some Q&A from the audience. So again, these three speakers, really looking forward to their deep dive on this topic. Again, going to share some of their expertise in terms of what things you should consider beginning now through the end of the year. Here's how you can interact. You've got a chat feature on Zoom. So you can either use Q&A or you can chat directly, type in your chat or your questions rather into the chat box. We will address all the questions before the end of the event here. The thing you might want to consider when you're typing in your questions is this: based on what these three stellar speakers are saying, what implications does that have for you as a business owner or as a C-suite executive as you frame up your business going into the second half of this year? What are the implications? And again, feel free to ask any questions. We'll get to any and all questions before the end of the session. All right, with that, I'm going to go ahead and bring up Michael Lewis, who is VP Private Wealth Consultant with U.S. Bank. Just got a wealth of knowledge. Michael is involved with a number of community organizations, is an expert in this arena. And again, I'll have him illuminate a little bit more about his background, but we're just delighted to work with Michael and his team in terms of the messaging that they have today. So Michael, I'm going to stop sharing and have you come on and bring you up. Let's see, Michael Lewis, you should be.
How's that? Can you hear me, Scott?
We can hear you.
Great. Okay.
Welcome.
Well, first off, thank you very much, and greatly appreciate all your support and your help over the last year in putting something like this together. And we couldn't be more fortunate to work with you. I'm looking at, there we go. You said a couple of things. You know, business owners' thought process the strategy in which they're looking at doing things right now, and then the planning aspect of it. I've been in banking a little over 30 some odd years, and working with business owners has been one of my ultimate things. I've run the business banking group here. I've run a retail banking group with the wealth planning or the wealth management group and the private wealth management side here. I've been involved with for about the last, 15 plus years. So working with business owners is something that I truly enjoy. I'm going to let you guys listen to the real experts here very shortly. But my role at US Bank in the private wealth management group is to really act as kind of your coordinator, quarterback, whatever you want to call it, and to help bring the bank's resources to you, whether that's wealth planning, and you're going to hear from one of our senior wealth strategists today, Mike Denzinger, whether that's the investment management piece of it. We've got people here in Orange County to help on that, the private banking side, and then the other person who's going to be working with us, and what I think is probably our most innovative and important topics today is our business owners advisory services. And you'll hear from John Heffernan in just a little bit. But that's with so many things going on as a business owner, and you guys are wearing all these hats, I'm one of those people that will help coordinate whatever you need to do. So if you say, I'm going to sell my business, I need to do this, I need to set something up, you could literally have a one-stop shop with Mike Lewis, and I can help out in anything that you're looking to do. So without anything else to talk about, I want to introduce Mike Denzinger. Mike Denzinger is going to be talking to us about, and I'm going to share my screen here for a little bit, and I'm going to pull up his slideshow, so bear with me. Mike Denzinger is going to be talking about, for the business owners, the pre-business sale, estate, and income tax planning strategies, and some of the implications that you're going to hear about from Mike. So I'm going to hand over, Mike, if you'd like to come over here and take over. That's it. And we'll have questions and answers following both of the topics.
That's great. Thanks.
Sure.
Thanks, Michael. Welcome, Michael.
Okay. I don't know if you can see me or not.
We can.
Oh, wonderful.
Looking great.
Well, thank you. Well, first, I'd like to thank everyone for attending this presentation titled, "Is This the Year to Exit?" So I think we're going to answer hopefully some questions, clarify some points. We'll first begin by looking at some of the proposed tax law changes that are on the horizon. Can't predict whether any of these will go through, but we can certainly address future planning towards the exit with that agenda. So speaking of agenda, let me go to the next page. Let's see. Roll it down. Okay. Oh, here we go. Okay. Sorry about that. There we go. This is a kind of an agenda of what I would like to cover today. We're going to talk a little bit about the proposed gift and estate tax law changes that could be on the horizon. I'm going to look at 3 different strategies. One is an estate planning strategy for business owners called the Spousal Lifetime Access Trust. I'm going to touch on that. And then we're going to talk about another strategy which we've been successful in using, and that is converting the business to a Section 1202 qualified small business stock. And we'll talk about why that would make some sense for some people. And then finally wrap it up with a more of a charitable strategy, but it also has tax ramifications, capital gains deferral on the sale of your stock inside this trust, also creating a retirement income stream for the business owner after that, and deferring it until they actually need the money. So these are the areas that we could cover. Let's talk about real quickly. I'm not going to touch on all of these points. And this is not a total list, by the way. These proposed changes are dealing primarily with just the gift and estate tax law. But let me just hit a few here. Right now, there's the big proposal is to reduce the exclusion amount that we can exclude from estate taxes. Right now, it is $11.7 million per person. That literally doubled under the 2017 Tax Act. It was around 5. So they could lower that as much as all the way down to $3.5 million. So for a business owner couple, that is significant. The business owner couple right now, and I'm going to talk about the strategy in a minute, can exclude right now up to $23 million together from estate taxes. So then they've done another thing. They've decoupled the unified credit, where it used to be that you get the same exemption whether you pass the assets through your estate or whether you gifted it while you're alive. Those exemptions were the same for many years. Now they're looking at decoupling it to only $1 million that one could gift in their lifetime to get it out of their estate. So these are very severe changes, and can't guarantee that they're going to pass in the current form, but certainly so. So a couple other ones: estate tax and gift tax rates over the exclusion amount right now is 40%, and they could include that and raise it to 65%. Okay, last ones here at the bottom. This is a major one: proposed changes to step up basis at death. See, right now, most of our business owners, real estate owners, are accumulating assets in their taxable estate with the idea that when they die, they're going to get a step up in basis going to their heirs. That is being challenged right now. The most draconian one is actually a due on death a capital gains tax on all assets that are passing in the estate that have a capital gain in them. That would be pretty radical. So finally, the corporate income tax rate, that was lowered to 21% flat. They're looking to raise that back to the 26 to 30% area. So all of these things play in to our proposal. Let's just go from there to the next strategy. And this is the first of the three I'd like to talk to. And by the way, I'm not going to go through or try to go through this diagram with you. I would just say that after I give you a high-level explanation of who it might be appropriate for, if you can follow up, if you'd like to follow up, I should say, with Mike Lewis. He keeps my calendar, and we can go through these diagrams and get into the deepest dive with you to see if it's appropriate. But the idea here is that for the business owner couple, which I see a lot of, by the way, I see a lot of closely held business owners that own their business inside their revocable living trust. And it's a community property trust that automatically splits 50% ownership for the wife, 50% for the husband. So this is how the strategy works. Basically, it is a irrevocable trust that each spouse sets up for the other spouse that will allow them to go ahead and move or remove the exemption amount, their exemption amount. And we just mentioned a couple right now is up to $23 million. That's 11.7 each. Remove that or gift that up into the trust and name each other as the beneficiary in case they want to go back to that trust and take money out for living expenses or to pay taxes or whatever. And this is a strategy that we've been using to push assets out of the business owner's estate early, get it to grow inside these trusts, because once it's moved into the trust, it's no longer in the owner's taxable estate, and it can continue to grow and not add to the estate tax burden. So this is something that we can go into a deeper dive if you'd like, on individual questions or even an appointment with everybody. So that would be the Spousal Lifetime Access Trust. It is an estate planning trust. It only deals with estate taxes. It is not an income tax planning vehicle. The other two strategies I'm going to talk about deal more with capital gains and deferral and income tax planning. So if we go to the next one, this is one of my favorites. This is a real darling of Silicon Valley over the last 10 years. And believe it or not, this thing was put into effect under the Clinton administration to level the playing field of a closely held business, a small business being sold compared to a large corporate business where there's all kinds of tax advantages. So this thing is interesting. The 1202 stands for the Qualified Small Business Stock section. Let me read you the statute real quick, just to brief. It says the statute provides an exclusion from income from any gain from the sale or exchange of qualified small business stock acquired after the effective date of the statute and is held for more than 5 years. So that's pretty strong. How about that? How about creating a business, starting from the get-go with this 1202 stock, and then we grow the business, hold the stock for 5 years, sell it, and pay absolutely zero capital gains. Anybody interested in that? I don't know. I think so. And the date when it came out, it wasn't a big hit because it offered only an exclusion of 50%, but there was an offsetting side of the tax. It was a tax preference item, and basically they got it back on the other side. If you have a company, a C corporation that was formed after September 27th, 2010, you probably need to talk to us or talk to your tax attorney. This is something that might be available. Now, you can't elect into this exclusion. This is not something that we say, oh, okay, this looks like a qualified business that could be, we can elect into this. You either have it or you don't. Okay, and so there are people literally that have sold their businesses and have had this tremendous exclusion available and did not take advantage of it. Yeah. So anyway, and so let me just tell you that in conclusion on this, it's got to be a company that's a U.S.-based C corporation, and it cannot be a holding company. It's got to be an active business. It can't be a personal service business either. I mean, we're looking for manufacturing, we're looking for businesses. So if it qualifies, we have a questionnaire that we can send to you just to rough this out. So that would be my second one, and I love it. And I'm going to just say end with that because I'm talking about how many of you out there like to watch Shark Tank? You know, I'm sure all your entrepreneurs like to watch this. I always envision the little girl that comes out there in front of the sharks and presents her super app that designs toys for kids. And, you know, Mr. Wonderful just tears her apart. He just goes, you know, this is never going to be profitable. You know, we can't scale this business, blah, blah, blah. You know, all the things he says. And, you know, as she leaves, you know, through the back door, you think she's crying, but she's not. She turns around and she says, oh, by the way, Mr. Wonderful, I forgot to tell you that my father, my tax attorney, created this as a Section 1202 stock. And guess what? All the investors that are coming into this are going to be able to sell this thing for $10 million tax-free in 5 years. That kind of changes it. So anyway, I just thought, I just laugh every time I see that. Let's go to the next and last one. And I'm just going to talk about this for a second. And that is the Charitable Remainder Uni Trust, and specifically a design of that called a NIM-CRUD. That stands for Net Income Makeup Charitable Remainder Uni Trust. You're at a cocktail party with a lot of lawyers and you say, I just formed a NIM-CRUD. They'll all come over and ask you about the details. You see Jim Cramer on TV touting all of his stock picks. He will say, hey, by the way, this is in my charitable trust. What he's referring to, it's in his NIM-CRUD. He's already taken a tax deduction for it. He can sell it inside the trust without paying capital gains, and he only pays taxes when he pulls the income back out for retirement. Those are the big advantages of the CRUD. And we can go into that a little further when we have some more time. But these are 3 strategies that I wanted to just touch on. And we have plenty more. We have other strategies. We have ESOPs. We've got charitable lead trusts, a lot of other things. But I just want to give you a taste of the planning that we can do. So I'll turn it back over to Michael Lewis for our next speaker. Thank you.
Okay. So let's stop sharing my screen here real quick and get back into here. All right. The next person I want to introduce is John Heffernan. John has been in the mergers and acquisitions business for, gosh, well over 20 some odd years. He's a CPA by trade, cut his teeth, has an MBA from Wharton. So one of the smartest men I've ever met. And I think he's got some great insight. If we could pull John up as well, we've had quite a few questions coming through already. And John, I have your presentation ready. And by the way, everyone's going to get Mike Denzinger's presentation. Everyone's going to get a copy of John Heffernan's presentation. However, due to time, John, would you have an interest in answering some of these questions that are popping up right now?
Yeah, I'm happy to just answer the questions directly.
Okay. The first one is, what's your outlook on the M&A industry right now in 2021?
I would say extremely positive. I've never been busier. You've got you've got record levels of dry powder chasing quality deals. Debt is cheap. Leverage levels are relatively high. And what's most important for business owners is we've got historically high EBITDA exit multiples. So valuations are pretty close to all-time highs. You look at what's happening in the public market, same thing's happening in the private market. One other notable trend, and I think pretty interesting for businesses valued in the 25 to 75 million range, is that if you look at private equity buyouts over the last 6 to 9 months, close to 75% of total transactions were what we refer to as add-ons, which is transactions in the 25 to 75 million range that were added on to a portfolio company in the private equity group of companies. Why would investors be doing that? Well, I think one clearly is it's a lower risk. Two, it's easier to underwrite. And three, it optimizes their ability to exploit what we refer to as expansion or multiple expansion, which is buy low, sell high. And they're consolidating fragmented industries, fragmented businesses, buying lots of them at lower multiples, and then selling the combined operation at a higher multiple. Mike, I can't hear you.
That was one of the questions actually, is about the multiples, but I think you kind of touched on that about, where are they? There's an interesting one here. How should I think about structuring?
Before you go there, let's go to the exit multiples, because I think that's important for business owners just to understand where exit multiples are at the moment. And if I could be a bit more specific on that. GF Data is a really interesting resource. They, for transactions in the 10 to 250 million range, they monitor that. So private company or buyouts of private companies, family-owned businesses, founder-owned businesses in that 10 to 250 million range, that's what they focus on a quarterly basis. So if I was looking at their most recent report, transactions in the 10 to 25 million range, trading at about 6 times. So 6 times EBITDA. 25 to 50 million range, trading at 7 times. 50 to 100 million at 8 plus, and transactions over the $100 million range trading at 9 to 10 plus range in terms of EBITDA. Those are averages across hundreds of transactions on a quarterly basis. And I do caution that they're averages because I was involved in 2 transactions recently that I think will be helpful for business owners or attendees to understand just where valuations are. One was a transaction in the payments as a service space. That business was doing about 10 in revenue, minimal EBITDA. We sold it for 100. The other one was a SaaS-based business in the healthcare industry, doing somewhere in the 10 to 12 in revenue, that we sold at close to 70. That was doing somewhere in the 2 million plus in terms of EBITDA. So clearly both of those transactions, they're substantially higher exit multiples or implied exit multiples than the averages that I've just referred to. And I think for any business owner that's contemplating a sale of their business, the issue is not finding a buyer. The issue is finding the right buyer who's going to value your business. If there's one other data point I'd like to share with business owners, the delta at a level of intent stage, so pretty close to final offers, there was almost a 40% delta in both of those situations between the lowest bidder and the highest bidder at the final LOI stage. Same business, same financial, same sale process, going through the same due diligence, deep-pocketed buyers, but there was a 40% delta between the highest bid and the lowest bid.
Thank you, John. You know, it kind of bridges to that gap right now. One of our guests just put out there, how would you sell, or how should a seller be thinking about structuring the transaction if they're getting a sell? I mean, we've kind of teased about sometimes you're, having that shotgun wedding where you're going to Vegas because boom, it just happened. Other times, you have a long engagement where you've got time to think about what you're going to be doing, do the estate planning, obviously with a Michael Denzinger. How should a seller be thinking about structuring a transaction?
So given the tax increases on the horizon, if Biden increases capital gains tax rates to 39.6 as proposed, let's see if that happens. But I think we're looking at a higher capital gains tax rate next year as opposed to this year. We currently have a 20% federal capital gains tax rate. That's the lowest it's been for about 100 years. So it's going up. The question is, how far is it going up? If I'm a business owner, I'm thinking about selling my business, that means that I need to focus less on price and I need to focus more on the forms of consideration. And in this situation, cash is king. Because if I can get cash at closing and I can pay 20% federal tax, that's much more valuable to me as a seller than accepting other forms of consideration that are very usual, very common, like a seller note, or an earnout, or an equity rollover. All those three forms of consideration, all they do is push part of the purchase price into a subsequent tax year where they're likely to be taxed at a higher rate. So one would be focus, maximize cash at close, minimize or eliminate other forms of consideration like a seller note, an earnout, or an equity roll. And I think that the second point would be frequently in purchase and sale of what's referred to holdback to cover indemnifications. So as a seller, you're making reps and warranties with respect to the business, and a certain percentage of the purchase price may be held back to cover the indemnification with respect to those reps and warranties. So it's very common for 5, 10, potentially 15% of the purchase price to be held back by the buyer to cover those indemnifications for a period of time. Generally, that holdback is like 12 to 18 months. So if you're selling a business for 50 million and the buyer wants to hold back 5 million, and that's a 12-month holdback, you're simply pushing that 5 million into next year. And if you're paying tax at 39.6 or close to 40% versus 20, that holdback of 5 million or 10% of the purchase price has just cost you an additional $1 million in taxes. So I would want to insist, if I had a buyer with respect to my business, that they take out rep and warranty insurance and that there's no holdback. So in summary, I would focus on cash at close. I would not accept materially any seller note, any earnout, any equity roll. And I would insist on the buyer having rep and warranty insurance to cover indemnifications.
Okay. Thank you, John. Boy, I tell you, the questions are coming in. So this is pretty exciting. There's a question about touching back on the multiples, but I think we could probably go into two different things here. My business is going to be worth more, in the next few years, growing rapidly. So would I sell now or pay taxes later?
Yeah, interesting one. A bird in the hand versus playing the long game. And that's a question that's been asked of me. I mean, I spend my time with business owners considering an exit. Generally, they're in their 50s, 60s, and 70s. But a couple of weeks ago, I was talking to a 70-year-old business owner. Business is probably worth close to 200 million plus. It's growing at 30% year over year. He asked that very, which is, look, I'm comfortable either way. I'm comfortable the business is going to continue to grow. So if Biden gets to a 30 or 40% tax rate, I'm okay because my business is going to be worth more later than it is today. So my response to him was, how comfortable are you that you could increase the value of your business by somewhere between 75 and 100% in the next couple of years? If you're not that comfortable in playing that long game and being able to almost double your EBITDA over the next 2 to 3 years, and you assume that exit multiples that are at record levels today are going to be there in 2 to 3 years, you'd be better off selling now in after-tax terms and paying 20% federal than you will attempting to double the value of your business in 2 to 3 years and paying 40% discounted back to today. So he was dealing with that dilemma, sell now versus sell later. He's now engaged in a sell process to sell the business because he understands it's going to take him 4 to 6 months to sell that business, and we're now in May.
I'm gonna ask you then to kind of touch back on the EBITDA and the revenues, and can you please repeat the multiples for the transactions you mentioned earlier? Revenue, EBITDA, and the selling price. And what multiple of EBITDA do you currently see on average?
Okay.
I think you touched on it earlier, but they'd like to have a review of it.
Right. So I would refer listeners to GF Data. It's an independent third party that does these reports on a quarterly basis. They're the ones that monitor takeouts companies for private equity firms, and to me, it's a very good resource in terms of what's happening in the marketplace. But looking at those 10 to 25 million exits, multiples averaging 6 times. 25 to 50 million exits, multiples times EBITDA. 50 to 100, average 8, and 100 million plus, averaging 9 plus. And you can see that there's a high correlation between the implied exit multiple and the valuation of the business. The bigger you are, the higher the implied exit multiple. Now, I did caution that those are averages. And really, every business, what is the value of my business? Say, who's the buyer? Because remember, I said before, in many processes, there can be 20, 30, 40% difference between the lowest and highest bid. It's the same business. It's just many buyers valuing the same business in different ways. So the sales process is finding the right buyer, not finding a buyer.
Okay. Thank you, John. This one looks like it's directed to Mike Denzinger. I don't know, Scott, when we want to kind of open it up for questions and answers, but there's one last one. Let me see here.
Yep, Michael, go ahead. If you got one for Mike Denzinger, please go ahead. Thank you.
Yeah, I know I'll be selling my business, but I'm not ready to sell yet. When should I start my planning? And so, Mike, you can come over here.
I guess we can change chairs.
Yeah, there you go.
Thank you.
You're there.
Okay. My answer is fairly similar to John's answer. The earlier we can begin, the more options we can present to the business owner, both from a planning perspective and obviously from a marketing perspective. The key to it is we always want to be kind of keeping in mind on what our prospective buyer looks like and what they're really looking to buy from the business itself. For example, if you're structured right now as a C corporation and the buyer only wants to buy your assets, they don't want to buy your stock because they're buying your liabilities when they buy the stock. So they only wants the assets. They want your clients, they want your business. We need time to restructure and get over into a different status, because if we sell the assets out of a C corp, we will subject it most times to a double taxation. It'll be trapped at the corporate tax level, and then when it's paid out in dividends, it'll be taxed at ordinary income to the owner. So that's one thing to keep in mind. So the earlier we can get involved. Another thing too is, are they looking to buy maybe your goodwill inside that business? So anyway, there's different things that we can look at, and the longer we have to plan ahead for the structure and the strategy, the more options we can present. So thanks.
Okay.
I would piggyback on that, Mike, by just saying that, it's never too early, but it's frequently too late. You get an unsolicited offer and you're caught by surprise. There's high value to being prepared, being ready.
I agree, John. And there's another one here about it, irrevocable. When should I be setting up these trusts? And I'm going to back up a little bit because I know Scott has a couple of things to say as well. Part of our role, we work as a team. So when you guys talk to Mike Lewis, you're getting John Heffernan, you're getting Mike Denzinger, you're getting, Pat Brown, Bill Dolan, et cetera. We work as a team, and we're here to support you guys. And like anything, you guys do planning, you're putting together a strategy for your business. Let us work with you and your team, whether it's your trusted CPA or your attorney. Let us work with you and put together something that makes sense. And like Mike and John both say, far often, and John and I are working on 6 or 7 clients right now, far often it's at the latter stage of their thinking of selling, and it doesn't give us the best options. We still have some, but we have to kind of, figure an option here. So earlier the better. And we'd love to set up a conference call or a meeting with any of you at any time. Scott?
Yeah.
What kind of time do we have? I know we're kind of
Yeah,
right
we've
at
got
time.
we've got a few minutes. I want to suggest a couple of things here. First of all, I see some of our community experts and super connectors on the viewing today, and I may pick on them just so you're ready. Justin, Jesse, Goran, Elko, I'd like to have your input and weigh on this because you work with a lot of business owners, a lot of C-suite executives. So if you could chime in here in just a minute. But I want to bring on Jason Duncan for just a couple of minutes because he has, right in keeping with this messaging, we need to take a step back. So John, Michael, and Michael have talked about preparing yourself. So Jason, I want to just bring you on for a second. You had some comments about, in particular, what's the preparation pre-sale, if that is the strategy.
Yeah, and a lot of these things work whether you're are good for the sale. They're also good, as you said earlier, for any company because there's all things that we need to do and make sure we have them in place. So the first thing is make sure you're clarifying your message because people people need to understand that you understand the problem that they have. And by clarifying your company's message, it attracts not only the right customers, but it attracts somebody that might want to purchase your business. We talked about knowing the problem, and this is all done through alignment. So here's an example of what we need to do. Make sure that all these things have an aligned message. And you'll notice I have your sales team on there because oftentimes what you say online or your sales team don't always work together. So by creating an alignment system, it helps make everybody's more effective and keeps the company going in the right direction, which is more attractive to somebody who would be coming in. Make sure you're using video. We had a client that used video and they used it to, again, talk to their customers, but the real reason they made that video was so they could sell. And they sold for a very large amount of money, and that video helped them attract that buyer. Make sure that you're clear on knowing your customer's journey. And here's some of the stages of the customer's journey. Then we take that journey and we create videos for each of those stages. And then finally, one other thing that you can do is look at web accessibility. So we've seen a huge increase in ADA compliance lawsuits, and it's become very important to make sure that your company is meeting all these guidelines on your website, right? We've had these things since the 70s, and now for our buildings, well, now that's been carried over to online. And the best way to solve that, we have an AI technology that goes through, reads your website, and within 48 hours, it's ADA compliant as much as it can be. So if you've got challenges where your website is not ADA compliant or you're not sure, contact me and we'll help you. We can run a free report for you and let you see where the holes are and where you're at risk. Again, these are all things you want to take care of. Again, more attractive to somebody that's coming in. And then finally, we talked about these 4 things in the last couple of minutes. If you need help aligning your organization, we have what we call the video alignment method. We'd love to talk to you about that. And here's my information if you'd like to connect.
Okay, thanks, Jason. Yeah, good kind of pre-sale preparation tips, whether it's pre-sale or not. So Michael Lewis, let's go back to kind of filling in the picture here. And I picked on a couple of members of my audience here. Justin, Jesse, if you want to weigh in on this, your comments or reactions, Goran, Elko, any of our audience members, feel free to unmute yourself and come on. Michael, I think you had a couple other questions too you wanted to share.
Well, yeah, one of them came out. It was just, how long does it take to sell a business typically? And that was obviously kind of towards John. It sounds as though somebody may be thinking, or maybe is getting an offer. So
It's a case by case basis, but in general, I would say to most business owners, 4 to 6 months. It can be different if you're running a full blown auction to find buyers, relative to having a few suitors who've been knocking on the door and you're running more of a discrete process. Over the last 6 months, I've been involved in some transactions, one that we closed within 90 days of engagement. But there was a relatively large private equity firm that wanted to preempt the process and did successfully. Another transaction took close to 5 months to complete from beginning to end, but we had 4 or 5 interested parties at the table from day one. And then, another transaction that probably took close to 9 months because it was a full-blown auction. So it really does depend on the circumstances, but I would say on average about 6 months. So if you are really interested in preempting Biden's proposed increases in capital gains tax, you'd want to start the process now.
and obviously they would engage us to start the process of talking, putting together financials, things like that.
Yeah, high value to being prepared. Some of the things that you need to are contemplating a sales process. Look, it's a roller coaster. In terms of setting business owner expectations, it's a roller coaster. It can be extremely frustrating. It can be very distracting on the business in terms of day to day. I say to most business owners, don't do double duty. It takes a village to sell the business. So have your M&A advisor, have your M&A attorney, have your tax advisor, and have your financial advisor. Make sure your financial affairs are in place, are taken care of, and then have the professionals manage the process. Because for most business owners, it's the first time they'll sell business. It's probably the last time they'll sell a business. And lastly, it's probably also a life-changing event. So, those that I've seen that attempt to do it themselves generally don't know how much money they've left on the table. Getting back to that business owner and 70-year-old that I met middle of last year, who thought his business was worth somewhere between 30 and 35, and we sold it close to 70. He could have sold it for 35, and he might have been happy selling it for 35 on his own, but he'd never have known that it would have left over 30 million on the table.
Yeah.
Yeah,
That's a
interesting.
great point.
Yeah,
And,
go ahead, Michael.
well, I was just gonna say, I'll leave you with one story that just is recent. And we have a client that, somebody come up unsolicited and they made an offer for the business. Unfortunately, he has his building that he conducts his business out of inside the corporation. And the company that wanted to buy the corporation, didn't want the building. And so they say, no, we'll lease it back from you. They didn't want some kind of a non-performing asset. And so because of Mike Denzinger, because John was saying, no, we need to hold off a little bit. And it's Mike Denzinger was able to, we're working on it, to get the building out of the corporation in a tax favored manner. And then the company is going to be ready to sell, which John is taking over the responsibilities of doing that. And the business owner had a great analogy. He goes, I don't want to go to a doctor and have him tell me what 6 surgeries I can choose from. He goes, I need you to tell me what I need to do. And we did. And we did exactly that. And he says, thank you. Thank you. He's a 70-year-old man. He just said, thank you for taking over. So to John's point, don't try to do everything. John's been doing this. He's done hundreds of these over the courses of his career. He knows the ins and outs. He can read an agreement and tell you this is typical in an agreement, but take it out. We don't want that in your sale agreement. So use us. And again, we work as a team. You're going to get a lot of good information. So.
No, I have to echo that. And by the way, a couple of questions have come up. You will be sent, the bios were sent in advance of this, but also after this session for all the registered attendees and those on our ancillary audiences will get the bios of our presenters. And please reach out to the two Michaels and to John. I do want to, we've got some more questions here and reactions, Michael Lewis. Justin Jesse, you made a couple of great comments here. Can you share that with the audience? And good to see you, by the way.
Yeah, good seeing you. Thank you. Hopefully see you in person here soon. Good presentation, guys. Two thoughts actually come to mind. One is tax has always been important, but sometimes it has become more of an afterthought. It's very clear that in today's tax regime or future tax regime, you've got to really be on top of it. It really comes to the forefront in terms of tax planning and how to structure and how to even potentially sell, maybe sooner than later. The second I will echo is your preparation is key. You need to be prepared. And I would say it's even more magnified in today's environment with what we're seeing out there with private equity and special purpose acquisition companies. There's a lot of dry powder and it's a seller's market. So you want to be ready just in case something comes across that you just can't pass up.
Yeah, great points.
Yeah, very, very good point. Again, well, obviously you brought up the SPACs, and that's a rapidly changing environment there. Just if you look at the news today. So again, this whole idea of staying ahead of the game, which is why we're doing this today, is absolutely essential. Jesse, good to see you again. Again, we will be back live very quickly, and we'll bring the two Michaels and John in alive too, because they've got so much great stuff to share. Elko, you've made a couple of comments here. I want to welcome Elko from Tech Coast Angels because they work obviously with a lot of business owners and C-suite executives. Elko, can you a couple of comments from you, please?
Yes, absolutely. I have to say I fully agree with the comments and the advice from the specialists from US Bank. And I want to point out that the multiples that were discussed are very specific for the industry that the companies are in. And we see very big variations when it comes to the multiples in high growth industries or in more stable industries. So any seller, I would advise to really go to a specialist who can give you a better multiple range before you commit to anything. Secondly, what we also see is that there are a lot of companies with growth strategies who like to bolt on some acquisitions. And especially the smaller companies are more heavily impacted by COVID. And that creates very interesting M&A environment where smaller companies get a high price, but a lot of them don't have the opportunities for growth that the larger companies have. So we think that it's going to be a very, very intense 12 to 18 months when it comes to M&A activity.
I certainly have to agree with that. John, Michael, comments there? You're seeing the same level of anticipation around M&A activity and certainly the timeliness of this discussion?
Yeah, absolutely. Look, I agree 100% with those comments, which is why when I gave out the multiples, I qualified it by saying that those are multiples for privately owned, bootstrapped in that $10 to $250 million range, but they're averages, and they're averages across hundreds of transactions. And that's why I also mentioned the two of the transactions that I've been involved with. One, the payments as a service, tech-based business, high growth, doing 10 in revenue, close to 0 in EBITDA that sold at 100. I mean, you can't correlate that with the average exit multiples that I referred to before that. And then the second one was the SaaS-based business. Again, high growth, 30, 40% year over year, 95% plus recurring revenues. So in the sweet spot in terms of SaaS and publicly listed companies in the SaaS space trading in the high single digits, low double digits in terms of revenue, not EBITDA. So I agree with the comments, which is, exit multiples. I don't view exit multiple way to value a business. To me, exit multiples are simply outputs. It's a data point, but it's a very dangerous data point to use to value your business. You really need professionals. And the comment about finding the right buyer, not any buyer, because the right buyer is going to pay the highest exit multiple, implied exit multiple than any buyer. Is it a strategic? Is it a financial? I mean, there's a lot of things that go into not just valuing a business, but the point is, what is the business worth to the buyer? It's not what the business may be worth to the seller or what the seller thinks the business is worth. It's really, what is the value of the business to the right buyer?
Yeah, there's one other comment here too. And John, thank you for that. And Elko, thanks for chiming in on your perspective too. One of the things we're hearing from the larger enterprise companies that's come up via COVID, and that is that their organic capability to create, to innovate, to move into ancillary channels is they've seen the limitations. So they've started to look outside and say, what are the acquired targets, strategic targets we can go after? And there's been a realization there's only so far you can take internal capability building, right? So again, there's this built up demand for acquiring the kind of expertise, the kind of talent, the kind of value propositions that'll take these larger enterprises forward. So that's certainly out there. So to all your comments, yeah, there's a huge pent up demand that's there. Well, we're at the end of time, but again, I want to thank our panel again. The two Michaels and John, thank you for your contributions. It's excellent. Again, our YouTube and LinkedIn audiences are asking how to get this. This was recorded, so it'll be posted on the ENP YouTube channel by Monday. And again, you'll get a copy of the presentation and the bios again of the presenters today. Michael Lewis, Michael Denzinger,
Yeah.
John, thank you so much. Excellent job. We look forward to having you again. I'm sure this
Thank
is
you,
a lot
Scott.
of conversation.
Greatly appreciate the opportunity, and we look forward to working with some of the folks on the call today.
Thank you. Thanks everybody for attending today. Look forward to seeing you again. I'll put up our next event. We'll look forward to seeing you on June 23rd. Perhaps we can have one of these three presenters kind of pop back in because I know you're going to have some questions then. Thanks again, everyone.
Absolutely.
Good afternoon.
Afternoon.
Bye-bye.
Take care, everybody.